everyone. Thank you all for joining us today for the first day of our third-party risk management boot camp. We are excited to have you join us around the campfire over the next 3 days as we go on a virtual camping trip to discuss important third-party risk management topics. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use. If you are not familiar with our webinars, all the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide those widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner of the widget. If you have any questions during the webcast, you can submit them through the Ask Question widget. Don't worry, we do capture all questions throughout each session. We will be answering some during the webcast, but those we do not have a chance to answer live, we will address with you via email. In the Related Content widget, you'll see a link to a copy of today's slide deck, a link to our website, a link to our samples library, a link to our resources library, which has hundreds of educational resources, and links to several specific resources that we feel may be helpful if you'd like to learn more about certain topics discussed today. This 3-day bootcamp is eligible to earn up to 6 CPE credits, 1 for each of the 6 live sessions, so 2 per day. If you wish to receive these credits, please remember to answer all the polling questions that will appear on your screen during each session's presentation. You will also be sent a follow-up survey link 24 hours after the bootcamp has concluded on Friday, April 21st, that will need to be completed in order to receive the CPE credit. Before we get started, let's go through introductions of our speakers for this 3-day bootcamp. Day 1 of the bootcamp will kick off with VinMinder's Hillary Dewhurst, who is Head of Third-Party Risk Education and Advocacy. She will discuss inherent risk versus residual vendor risk. After that, Greg Cameron, VinMinder's Head of Third-Party Risk Advisory, will discuss steps and strategies for vendor due diligence. Tomorrow, for Day 2 of the bootcamp, VinMinder's President, Kelly Vick, will join us to discuss an overview of critical vendors, fourth parties, and exit strategies within a contract. Then, Lisa Mayhill, VinMinder's Information Security Operations Director, will walk us through third-party risk management and supply chains, followed by an understanding of vendor data breaches, and wrapping up Day 2 with discussing complementary user entity controls within vendor SOC reports. On Thursday, the last day of our bootcamp, Hillary Dewhurst will join us again to discuss environmental, social, and governance, or ESG. Then Raman Zachariah, VinMinder's Chief Financial Officer, will join us to discuss your vendor's financial health in today's business climate. Next, Jill Sherman, VinMinder's Third-Party Risk Principal, will walk us through the importance of vendor performance management. And after Jill, Hillary Dewhurst will join us once again to wrap up the bootcamp with an overview of program metrics and reporting. So let's dive into the first hour with Hillary Dewhurst, covering the basics of what you need to know when it comes to inherent risk versus residual vendor risk. With all that being said, I'd like to hand it over to Hillary. Hillary, the floor is yours.
Welcome, everyone, to our first session of our Spring Boot Camp for 2023. Today, I will be walking you through inherent and residual risk in this first session, and we're going to start off with just understanding what inherent risk is. And we'll talk about the types of risk that we are looking for during that risk assessment. We'll also spend some time talking about how to determine criticality, and then we'll move on to understanding what mitigating controls are and how they affect your ultimate outcome of residual risk. We'll also talk about how to apply those two concepts of inherent risk and residual risk in your program, and then we'll wrap up with some key takeaways. Now, to start off, I want to introduce you to the third-party risk management lifecycle. And the third-party risk management lifecycle is basically the roadmap for third-party risk management. And you're going to be seeing this over and over again throughout the boot camp because we're going to discuss each of the steps and activities in the lifecycle. Now, some just quick things to know. First of all, the life cycle is divided into 3 distinct stages, and those are onboarding, ongoing, and offboarding. And each stage has its own activities that take place in a predetermined order. And since we're talking about risk assessments today, I want to point out that throughout the life cycle, we're constantly assessing and reevaluating risk. And how we do that may vary a little bit depending on the stage of the life cycle we're in, but it is a common thread throughout the relationship we have with our vendors. Now, you'll also notice that governance is the foundation of the life cycle, and that includes oversight and accountability, documentation and reporting, and independent review. This year, we decided to switch things up a bit, and instead of going through the whole life cycle in a single session, we're going to focus on these various stages and components of the life cycle in individual sessions. So to start with, we're really focusing on risk assessment and the concept of inherent and residual risk. Because one of the very first things that we need to do in third-party risk management is to really determine the types and amounts of risk that need to be managed. And we do that in that onboarding stage. So let's discuss that for just a little bit. So one of the reasons that we're starting off with inherent risk and residual risk is because understanding and planning for the risk of every relationship is one of the very first things that we need to do, not only because we're following the life cycle, but so that we can establish the boundaries and guidelines of that vendor relationship. So during these initial stages, we go through something called planning, and this is how we prepare ourselves to manage that relationship throughout its lifetime. And as part of that, we have to identify all the risks associated with that product and service, and therefore the relationship. We also have to identify if this particular relationship is going to be critical to our operations or to our customers. So it's really helpful to just start off with some basic definitions so that we're all working from the same page. The first thing is risk. Obviously, that's exposing someone or something valued to danger, harm, and loss, and I think we all know what that is. But let's talk about inherent risk. Inherent risk is the risk that occurs with the product or service naturally. As an example, any vendor that requires the use of sensitive data to deliver their product and service, there's always a risk that that data could be compromised or under a cyber attack. Now, it's really important that when we're talking about inherent risk, that we're only talking about that base risk or that raw risk. We're not thinking about all the things we could do to control or reduce that risk. And that is the point of inherent risk. It's inherent to the product or service. And we usually always measure that risk on a scale of low, moderate, or high. Now, the next thing we need to consider is the criticality. And this is something that really reflects the business impact on your organization if that vendor fails or goes out of business. So anything that's necessary to sustain our core operations, interface with our customers, or maintain regulatory compliance would be a critical product or service. And we also have to identify every single vendor is either critical or non-critical. And that brings us to residual risk. Now, residual risk is the measurement of risks that exist after we've applied our controls and we've validated the risk practices. So it's the leftover risk. And residual risk is really an important concept because there is no way to eliminate all your risk. It's just not possible. I mean, it might be possible because the only way you can eliminate vendor risk is not to have vendors at all, but that's not a very practical solution. So we have inherent risk, which is the risk that naturally occurs with the product and service. And we have criticality, which considers the business impact should the vendor fail. And then we have residual risk, which measures the leftover risk after we've applied controls. So let's take a look at how to integrate each of these concepts as part of third-party risk management. So as I mentioned on the previous slide, inherent risk is really that raw or natural risk that's always present in the product and service and therefore would be extended out to that vendor relationship. And we're not thinking about any risk reduction measures at this point. We're just measuring it based on that raw risk. When we identify and measure that risk through a formal and standardized inherent risk assessment. Now, one thing that's really important to keep in mind is that risk assessments are always internal documents. These are never completed by the vendor. This is always something we do internally. So that may bring up the question, okay, what kinds of risks are we actually looking for? Now, there are several categories of vendor risk. We've presented probably the most common ones you'll see, but there are certainly more. I'll just walk through them briefly. Operational risk is that risk that there's a failed process, system, people, or control, and that has a significant impact to your operations. This can be because of something that happens internally, or it can be external, like a natural disaster or a cyber attack. And then there's business continuity risk, which is the risk that the vendor would not be able to sustain their operations at an acceptable level during or after one of those big interruption events. There's reputation risk, which is the risk that you run anytime your vendors are working directly with your customers or they're utilizing your name or your brand. And this is all the bad stuff that can happen to your reputation if that vendor does something wrong. There's compliance risk, which exists when your vendors fail to comply with all laws, rules, and regulations, and there are quite a few of them. There's geopolitical risk, which is becoming more prevalent now with things like the Russia-Ukraine conflict and, forced labor and human trafficking. And this can happen when you are doing business with a vendor who is either directly or using facilities in another country. Maybe that country has, severe conflicts, political unrest, maybe their currency isn't very stable, or there's a lot of corruption. We also have information security risk, also known as cyber risk, and this is probably top of mind for literally everyone these days. And this can be any risk related to the cyber or physical security of your data and information, and not just your data and information, but your customers. So that's the risk that that information could be lost, stolen, breached, held for ransom, etc. There's transaction risk, which is the risk when a company is processing financial transactions for you. Let's say they take a credit card for a payment, and if that transaction is not processed properly, it could cause a lot of negative impacts to both your organization and the customer. There's financial risk, which is the risk that relates to the financial stability of the vendor and the fact that they may not be able to meet all of their contractual obligations to you and other customers if they have poor financial health. And there's strategic risk, which is the risk that your vendors' actions and decisions aren't really aligning with your organization's strategic objectives. Now, those are just a few. There are more, but I want to show you how we might look at some of these risks when it comes to an inherent risk questionnaire. Now, if you're feeling a little bit intimidated by inherent risk questionnaires, you really don't need to. The fact of the matter is these are usually pretty short documents that are asking very high-level questions about specific risk domains. The purpose of this exercise is to identify what risks exist and how much of that risk exists. And then once we've identified that there is a risk, that is a prompt to have us go research the vendor's risk practices and controls in relationship to managing that particular risk. So not a lot of questions here, and they're usually very high level. Just a few examples. The questions usually align with a specific risk domain. So for cybersecurity, for example, is this a technology-related service that needs to integrate with our network, or will they have access to our network? When it comes to transactional, is the vendor going to process financial transactions on our behalf, or will they have access to any PCI data? We'd also want to think about the operational risk. Is sensitive data being accessed by this vendor, and will they have unescorted physical access to our facilities? These are just a few samples of the kinds of questions that are asked on inherent risk questionnaires, and you can see they're not super involved, and you probably won't have a ton of them. This is just basically a way to kind of zero in on the risks in the product and service so that we can align our investigation of those risk controls to the vendor. Okay, so what are some other important things to know about inherent risk ratings? Well, first of all, that risk rating, that result of your inherent risk assessment, is really a cumulative rating of the entire engagement, keeping in mind that some areas may be high risk while others are low. You want to come up with sort of a blended rating that reflects both the amounts and types of risks present in the engagement. Remember, we want to consider that these risks are existing in the product and service first, and therefore they can almost be vendor agnostic, right? Because it's the due diligence that's going to help us understand whether a specific vendor can address those specific risks. It's a really good practice to use as straightforward and simple risk rating scale as you can. Best practice is low, moderate, and high. Now, if your organization is using something else, that's okay, but you need to be able to articulate and defend why you have the different ratings and how you would treat each vendor differently. So how would a medium-high vendor be treated differently than a medium, for example? You need to make sure that your risk rating methodology is always standardized and documented, because we want to get, you know, good, clean results when we do these risk assessments. We shouldn't have a lot of subjective information on there. We also never, ever, ever want to use critical as a risk rating, and I'll get into that in just a bit. And then keep in mind that these risk ratings are just not a one and done thing, that we have to periodically reassess those risks to make sure that we're still dealing with the same amount of risk and that there's no newer emerging risks that we need to address. All right, so how can we apply these risk ratings in our third-party risk management practices? Well, first of all, remember that risk ratings are your best tool to help you identify which vendors you have to pay the most attention to, which vendors are going to need the most robust due diligence, how specific contracts should be structured, how often you need to risk reassess them. And in truth, your vendor risk ratings are really going to help you set up the cadence and the management routines for any particular vendor throughout its lifetime. So, for example, let's take a moderate risk vendor. It's likely that they're only going to need formal performance management maybe once or twice a year, and that they are only going to need that periodic risk reassessment every 18 months to 2 years. Compare that with a high-risk vendor that's going to need quarterly risk and performance reviews. They're going to need an annual risk reassessment and due diligence update, and there are going to be different considerations when we're going to review and possibly renew that contract. Just keep in mind that your auditors and regulators are going to expect every vendor in your organization to have a risk rating. That's one of the reasons we don't want those inherent risk questionnaires to be too drawn out, because we want to make it a practical exercise that's not overwhelming to achieve. So, we've covered a lot in the last little bit. Let's take a break for our first poll. Jessie?
And this brings us to the first poll question of the boot camp. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. Please remember, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This first question is, how did your organization determine the vendor's inherent risk? Best guess based on services and no real quantification, by a points or tally system or other homegrown methods such as Excel, a methodology unique to a software application, or other. Hillary, it looks like we have some time to answer one of the questions that has come in so far.
Okay, let's do it.
Great. Do you have to have an inherent risk rating if your company isn't regulated?
Short answer is absolutely yes. Now, the reason why is because to manage risk, we have to know what risks are there and in what amount. And that inherent risk rating process is one of the very first things you do to kind of suss out, like, how do we need to treat this vendor throughout our relationship. So you absolutely do need to have an inherent risk rating, whether your organization is regulated or not. I hope that's helpful.
Thanks, Hillary. We have about 30 seconds left on this open poll question, so please get those answers in as quickly as possible. We always appreciate everyone's responses. Thank you. Thanks, everyone, for answering that poll question. Here are those results. By the way, you may have noticed reactions such as a thumbs up or heart coming across the screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right-hand corner of the Slides widget, which will expand the slides to full screen and no longer show the reactions. Before we move on, in the Related Content widget, you'll find our 3 planning steps before you onboard a vendor resource available for download. Hillary briefly touched on planning earlier in the session, so we felt this is a helpful resource to refer to. Back to you, Hillary.
Now, we talked a lot about inherent risk, and now you have your risk rating, but that is not the only piece of information you need. In fact, another piece of information, potentially a more important piece of information, is how critical that product or service, and therefore the vendor, is going to be to your organization. Now, you've probably heard the term critical vendors, but when we talk about critical vendors, these are the vendors that are essential to keep our business running. These are the vendors that if they fail or have an unplanned prolonged outage or they go bankrupt, our organization would be in really big trouble. So when it comes to identifying them, we have 3 questions we usually can ask, and this works pretty well. The first one is, would a sudden loss of this vendor cause a disruption to our organization? And would that disruption impact our customers? And if the time for the vendor to recover their operations took more than 24 hours, would there be a really negative impact to our organization? If you answer yes to any of those questions, chances are you are dealing with a critical vendor. Now, some people go ahead and identify their critical vendors even before the inherent risk rating. Whichever way you do it is fine. We just need to have both pieces of information, and especially when it comes to critical, there are a lot of expectations around critical vendors. So let's take a look at those. So first of all, your critical vendors are going to need the most extensive and rigorous due diligence, risk and performance management, and risk monitoring. And we always have to be able to provide evidence of those practices. We need to make sure that we're constantly aware of any new or emerging risks with our critical vendors, and that's why we need to make sure that they undergo a periodic risk reassessment and updated due diligence at least on an annual basis, if not more frequently. Keep in mind that your senior management and your board need to have visibility to those critical vendors and should be paying attention to how those vendors are performing and if they have any issues or renewing contracts, etc. And because critical vendors are so important to our operations, we always need to consider those vendors in our organization's business continuity and resiliency planning. And last but not least, your auditors and regulatory examiners are always going to consider your critical vendors in scope for any of their reviews. Now, earlier I said that you should never use critical as a risk rating, and hopefully you're starting to understand why. But let's look at these 2 pieces of information. First of all, your criticality is always speaking to business impact. It is not a risk rating, and it's merely a label we use to identify that relatively small subset of vendors that are mission critical to the operation, right? So this is a label, it's not a risk rating, and it's just a way to easily identify those vendors that are most essential. And remember, every vendor needs to have a label of either critical or non-critical. Now compare that with our inherent risk ratings. Remember, our risk ratings are reflecting the aggregate risk of the vendor engagement. And they're looking at both the types and amounts of risks that are present. And we want to scale that on a scale of low, moderate, or high. Now remember, all vendors need both pieces of information to be managed effectively. We need to know if they're critical, and we need to know their risk rating. Okay, now that we understand inherent risk ratings and we understand criticality, it's time to just touch on due diligence really quickly. And I don't want you to get stressed or worried if we don't go into this in great detail, because the second session today, which will be presented by Greg, is all about due diligence. So we definitely want you to come back and join that one. But just to give you a high-level understanding here, due diligence is absolutely essential to our risk assessment and management process. And due diligence is really a process that has several components. So the first one is we ask the vendor to complete a very detailed questionnaire about all of their risk controls and practices. We also ask the vendor to provide documented evidence of those risk controls and practices. That's what we call due diligence documentation. Probably sure you've heard that one before. And then finally, those two components are reviewed by a subject matter expert, and they're assessed and evaluated to confirm that the vendor's control environment is actually appropriate and suitable to control the risks that we've identified. Now, we always have to complete our due diligence before we can get into any risk handling techniques or figure out our residual risk. Now, on the previous slide, I said risk handling techniques, and you may wonder what the heck those are. Well, let's discuss this for a little bit. Let's assume that you go through your due diligence and you've established that there is residual risk, and we'll just talk about that shortly. But we have to decide what we want to do with any risk that's left over. So there's 4 basic risk handling techniques, and we'll go through them each in detail, but they're to accept the risk, transfer the risk, avoid the risk, or mitigate the risk. All right, well, you can avoid the risk. You can just not do it. You know, that inherent risk assessment can help you understand if there are avoidable risks. You know, some examples might be not sending more information than you need to, or, you know, not using certain methods for transferring data, like, hey, don't send customer data through email. You know, we have ways to avoid risk, but there's also a point where we just decide that, hey, the risk doesn't outweigh the benefits, or it's beyond our organization's risk tolerance and appetite. So we just don't do it. On the other side, there's the option to formally accept the risk. Now, the point of risk management first is to understand the risk and then decide if the risk is acceptable. And you know, there will be times when risk just cannot be mitigated. And that's part of doing business. You know, it is what it is. The point is to always make sure that the senior management is aware and can make really informed decisions about what to do. You know, sometimes that decision is going to be, we're going to accept the risk. It is what it is. We can't really change it. But the best practice for any risk acceptance is to make sure that it is formalized, that is documented with the appropriate justification, and that it is approved by the right level of management. All right, so the next risk handling technique is transfer. Now, I want to say something right off the bat here. There is a saying in the third-party risk management world that you can outsource the product or service, but you can't outsource the risk. You do not mistake this transferring technique for getting rid of the risk. You still own all the risk. What we're talking about here is to transfer the risk to insure against loss, right? So the best examples of this would be insurance policies or contractual terms that still hold your organization accountable, but ultimately transfer that financial impact to another party such as the insurer or the vendor. You know, you can transfer liability, but ultimately you still own the risk. The last technique is to mitigate, and this is what we see most common. This is what we're doing probably day in and day out with our vendors, and that is to implement controls. So controls come in different flavors, but the two most prevalent are preventative controls, which basically prevent bad things from happening, right? Or detective controls, which identify when something has gone wrong so that we can fix it. So I'm going to pause just a bit and talk about controls in more detail because we have such a wide variety of participants that join our bootcamp calls. I want to make sure that everyone really has a good foundational knowledge of what is meant by controls. So basically, controls are a combination of people, processes, and tools that are put in place to prevent, detect, or even correct issues that are caused by unwanted events. Now, when we talk about mitigating controls, we can be talking about internal or external controls, so something we're doing or something the vendor is doing. You know, some examples of internal controls might be requiring a separation of duties so that the person approving the expense is not the same one writing the check, or ensuring that a quorum of committee members are present before taking a really important vote. Employee background checks are another example. You know, encryption, dual authentication, these are all examples of controls. Another example might be is, let's say you have a vendor, they're going to provide customer service for you at their call center, and one of the risks that we have in that activity is that the customer is going to be dissatisfied. But if we ensure that the customer service agents are really well trained in both issue remediation and appropriate messaging, we could probably reduce that likelihood of customer dissatisfaction. So that might be one of the controls we use to address that risk. Now, I hope that solves the control issue, or at least gives you a little more flavor. And while you're thinking about controls, I think it's time to take a break for our next poll. Jessie?
Our second poll question of the day is, does your organization perform an inherent risk assessment on all vendors? Yes, sometimes, no, or you're unsure. Hillary, I have another question here that I think we could go ahead and answer.
I'm ready.
Great. And that question is, we use a risk rating scale of low, medium, medium-high, high, and severe. Is that okay?
Well, the first thing I want to say is, just like many principles in third-party risk management, how you create your tools and methods is really up to you and your organization. But as a best practice, one of the things we think about when we're using a rating scale is to keep it as simple and straightforward as possible. So for example, you have medium and medium high. I would just be curious to know, like, what is the difference between those two? Does it change what due diligence you're doing or how often you review that vendor? If there's not a lot of difference, then there's probably not a lot of value of having that extra layer. The other concern here is the risk rating as severe, which again adds another layer. And the term severe could also cause confusion in your organization as to whether those are your critical suppliers or not. So in my experience and as a best practice, I would really try and limit those to only the risk ratings and levels that make sense, and make sure that you have a clear idea what the difference between them would be. I hope that helps.
Okay, here are those results. Thanks again, everyone, for taking the time to answer the poll. Before continuing, I would like to direct your attention to The Process of Inherent to Residual Vendor Risk infographic, available for download in the related content widget. This resource is great to see the visual process of inherent to residual vendor risk while clarifying more about both concepts. Okay, back to you, Hillary.
So now you're probably wondering, okay, I understand about inherent risk ratings. I know about vendor due diligence. I understand controls. How do I calculate or measure my residual risk? So there's a very basic formula here. It's inherent risk plus validated controls equals residual risk, right? That answers all your questions. No, I'm sure it doesn't. Let's take a look at how this works in action. Okay, so let's walk through an example that might make it easier to understand how this works. So in this example, let's pretend that we are engaging a vendor to provide collection services through a call center. Now, this is a pretty high-risk activity. As you can see, the inherent risk is high, but some of the contributing factors for that would be that there's a lot of operational risk. We need to have them available and running 24/7 because people are trying to pay payments. They don't want to go to collections, so we need them to be up and running all the time. We also have a lot of compliance lists because collections agencies need specific licenses to operate, and so we need to make sure that they have those as well. There's also a lot of transaction risk because we are taking payments, whether that's through credit cards or bank transfers, wire transfers, etc. And of course, there's a lot of cybersecurity risk because they are touching all of this PII or the sensitive and confidential data. So at this point, when we look at the risk, it is high because we're not thinking about any of those controls yet. So let's assume that we are going to move forward. We're going to do our due diligence, and this is what we find. Well, we discovered after completing our due diligence and having that SME really review and analyze and validate all the controls that the vendor does have some really good controls. So from an operational risk standpoint, we saw that the vendor has really robust business continuity and disaster recovery plans and that they've been tested recently and there were no findings. From a compliance risk standpoint, the vendor was also able to provide us copies of all of their licenses that show that they are legally able to provide collection services in the states where they operate. From a transaction risk standpoint, all those credit card payments, the vendor was able to demonstrate and prove that they are PCI certified, which is very high standard, so we can breathe a little easier there. And from a cybersecurity standpoint, the vendor had a very satisfactory SOC 2 Type 2 report, which for those who are unfamiliar is an independent third-party audit that takes into account all of the vendor's risk controls and practices for cybersecurity, information protection, and privacy. So great, we can feel really good. And those controls now, they have a little bit of weight because they're really good controls. And so they're helping to offset that inherent risk, which would then bring our residual risk or our leftover risk to more of a moderate level. Great, right? Well, I want to point out a couple things. Yes, the residual risk is great and we are doing the right work and it's showing in our residual risk, but we can never eliminate that inherent risk. It never goes away. It is always there. It is always high. Controls just help us get a little bit more comfortable with taking that risk. Now, I'm going to use a different example here I think everyone can understand, and that's riding in an automobile. I think everyone's been in a car at least once or twice in their life. So when you get into a car, whether you're a passenger or a driver, there is always a risk of an accident or some other event that could cause you or your passenger severe injury or death. Now, I know that's really grim, but that is the truth. That is the risk when we get into a car. Now, fortunately, automobiles of today have a lot of built-in controls, but one of the most important ones that everybody is required to use, something called a seatbelt. Once you strap in and you click that seatbelt, you have implemented a control that will automatically help reduce the likelihood or severity of a serious injury or even death, right? The seatbelt in and of itself does not eliminate the risk of an accident, okay? It just helps us get more comfortable with taking that risk. Now, to take this a little bit further, maybe you're thinking about riding in a really cool old car, like a convertible, but it doesn't have a modern seatbelt. Maybe it's just across the lap or doesn't have any seatbelt at all. You may feel a lot less comfortable about riding around in that car, or certainly putting one of your children or your family members in it, because that control is missing. So I hope that really helps illustrate that point. We can never get rid of inherent risk altogether. What if the residual risk is the same as your inherent risk? Because this happens all the time. So your inherent risk was high, you added those controls, and it's still high. What do we do then? Well, the first thing we should always do is stop and review, because we want to make sure that we've adequately accounted for all the controls, that we really understand them, and that we've properly validated them. If we have, then we need to decide which of those risk handling techniques we might need to use next. So the first one is mitigation. Can we add different or additional controls that would help reduce the risk? Now, if you go ahead and decide to do that, of course, the subject matter expert is going to have to review those additional or different controls before we can really figure out our residual risk. If you cannot add those controls, then you have your choices. Maybe we can have the vendor carry extra insurance to transfer some of that financial liability. Or maybe we can just avoid the risk altogether. We decide, nope, we're just not going to take on this relationship. It's too risky. Or the last one is maybe we need to have our leadership sign a risk acceptance with the documented justification, because in this case, the risk just is what it is. Maybe there's nothing that can be done about it. So that's what you do when your residual risk is the same as your inherent risk. Now, one thing to also note is your residual risk should never be higher than your inherent risk. If you're finding that, then something is really going wrong in the process, and you need to step back and really review what you're looking at for controls and how you're calculating both your inherent risk and your residual risk. All right, so best case scenario, your residual risk is now lower than your inherent risk. Well, what does that mean? It means like, yep, we're probably good to move forward, get our contract signed or renewed, and to start setting up those routines to monitor and manage our vendor throughout the rest of its lifetime. Remember, we're only going to use our inherent risk scores to do that. Now, just because we feel confident right now doesn't mean we can take our eye off the ball. And that is why we need to constantly monitor, we need to periodically reassess this risk, and we really need to just stay aware of any events out there that might affect our third party, therefore affecting our organization or potentially even our customers. Okay, so how do we use residual risk scores in our program? Well, I think we've covered the first two bullets pretty well, but let's jump to the third bullet here, and that is that residual risk scores can help you identify those relationships that are still very risky for your organization. Now, all things considered, if you have limited time and resources, like most of us do, then you're going to want to throw your energy towards managing those relationships that pose the greatest risk to your organization or its customers. So for example, let's say you have two vendors and they both have an inherent risk rating of high. Well, after doing due diligence, only one of those vendors has a residual risk rating of moderate. That means that for the vendor who has an inherent risk rating of high and a residual risk rating of high, you're going to want to really keep your eye on them. You may want to add some extra monitoring routines or take some actions to really make sure you're managing that risk the best that you can. And even the risk that you can't mitigate through controls, you should at least monitor it more rigorously. Now, one more time, please do not ever use your residual risk rating to determine how often your vendor should be risk reassessed, how much due diligence you might need, what kind of performance management is required. All of those vendor risk management routines must be established using inherent risk, okay? If you do not take this advice, I guarantee you this will be an audit or regulatory exam finding just waiting to happen. Okay, let's take a little break and go to our last poll for the session. Jessie?
Our next poll is, our organization has a standardized method for determining residual risk. Yes, one is in development, no, or you're unsure. Hillary, let's go ahead and answer another question from the audience.
Okay.
This next question is, are we supposed to document the residual risk rating somewhere?
Yes. Actually, the reason why you need to document it is you should have a mechanism or a methodology that's helping you determine that. And by documenting it, you can come back in, say, an auditor or regulatory examiner would want to see, well, okay, show to me that you had acceptable residual risk so that you could move on with that contract or renew that contract. So you need to have it documented. Now, depending on how your system's set up or what your methodology is, you may have a couple ways to do this, but I definitely should be able to see the inherent risk rating of the engagement and the residual risk rating after due diligence has been completed and any issues are remediated. I hope that's helpful.
Thanks, Hillary. As a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This poll question will be closing in just about 20 seconds, so please get those responses in as quickly as possible. Thank you. Here are those results. Thank you, everyone, for answering this question, as it is interesting to see what everyone says. As a reminder, in the related content widget, we have our inherent vendor risk samples, questions, and next steps ebook and questionnaire. Be sure to check out these helpful resources. Hillary, back to you.
Before we wrap up today, I do want to touch on these periodic risk reassessments I've been mentioning throughout the presentation. You know, this is something that happens during the ongoing phase of the life cycle, and it is necessary to constantly reevaluate whether or not the risk that we're dealing with is the same, or if anything is new, or there's evolving risk there. So the way we do this is we start by having that vendor owner or that line of business owner confirm by reviewing the previous inherent risk assessment that everything is the same. If there's been changes, then of course that risk assessment will need to be updated, and that will trigger all the necessary information to go out to the vendor, additional documents to be collected, and the SME review. If nothing has changed, then we just ask the vendor to review and update their risk questionnaire if necessary, and provide the most recent copies of their due diligence documents. Now, a good standard for this is every critical and high-risk vendor needs to have this happen at least once a year. For your moderate, it can be every 18 months to 2 years, depending on the product or service and what your organization deems appropriate. And for those low-risk vendors, every 2 to 3 years, or when you're going to renew the contract. Okay. So just some key takeaways from what we've learned today. When it comes to inherent risk, always remember that that inherent risk assessment is an internal document, and it's your vendor owner or whoever wants to bring that relationship into the organization that should be filling out that document. Inherent risk only considers that raw or untreated risk, and we use our risk ratings to really help us determine what kind of management practices and routines we're going to use with those vendors throughout their relationship. When it comes to residual risk, this is something we can only determine after we've completed due diligence. And at that point, we'll decide if the risk treatment has been enough, or maybe we need to do something different or something more. Never, ever, ever use that residual risk score in place of your inherent risk rating when setting up your vendor risk management routines. Keep in mind, due diligence is a necessary practice. We can't really guess at this, so we need to have a systematic approach to determining if the vendor's controls are going to be sufficient. And periodic risk reassessments and updated due diligence are essential and are going to take place on a periodic basis over and over again throughout the vendor's relationship. Now with that, I've concluded my portion of the presentation, but I hope you'll stay tuned for Greg's session on due diligence coming up right after the break. And I'll turn it back over to Jessie. Jessie?
Great. Thanks so much, Hillary, for that informative session. Before we move on to our next session, where Greg will discuss vendor due diligence, we're going to take a quick 10-minute break. Please meet us back right here in 10 minutes. You do not need to close out and log back in. Just simply leave everything as is. Welcome back, everyone. Now we are going to move into our next session, Steps and Strategies of Vendor Due Diligence. We'll be hearing from Greg Cameron, Head of Third-Party Risk Advisory. Greg, the floor is yours.
Thank you, Jesse. Well, looking at the agenda for due diligence, we'll start off with what vendor due diligence is, why it's so important. We'll talk about risk-based vendor due diligence and this relationship to the previous life cycle stage in risk assessment. We'll look at what documents you should be collecting on your vendors, what to do when you can obtain documents from your vendors, and some of those challenges that we all face. And then we'll wrap it up with some key takeaways for you all. So as we look at due diligence within the third-party risk management lifecycle, we see it first and foremost during onboarding. This is the first pass of due diligence, following risk assessment, but prior to contracting, understanding the controls that are in place. We also see it in the ongoing. So this will be revisited on a regular basis. Want to make sure that what you saw previously hasn't changed or degraded in any way. And certainly any observations from the first pass that required some improvement, you're going to want to have recognized in the future passes. And you're going to be continuing to perform due diligence on a regular basis, but it will vary depending on criticality and risk. So we'll talk a little bit more about that through the following slides. But just remember that this is not one and done. This is going to be done on a regular basis. So what is due diligence? Well, it is one of the most important activities in the life cycle. This follows risk assessment, of course. You're understanding what's been triggered from risk assessment, what are the control areas that you want to look at and scrutinize. So you're collecting, you're reviewing, and you're assessing that information from the vendor to make sure that they have the right processes in place to protect you and your customers and your information. This also allows you to identify controls that you might want to put in place in your organization. That might be your own business continuity efforts or your own contractual clauses that you're inserting that allows you to, for example, continue the right to audit or demand certain testing of their controls in the future. In the end, due diligence also allows you to determine residual risk. These controls that are being evaluated are risk reducers. So you're able to now get a better sense of how the initial inherent risk has been reduced for a residual risk. So the importance of vetting and initial due diligence is to allow you to make an educated decision. Do you want to go into business with this particular vendor? Do they have the right controls in place? It is required by regulators. In a moment, we'll list some of those out for your reference. As discussed, this identifies gaps and weaknesses in vendor controls. A decision has to be made. Are those controls enough that you can accept them, or are they not enough and you don't want to go into business because they're too weak and maybe there's a better vendor that you can go with? Again, this identifies internal controls that you might want to implement as you're performing due diligence on your vendors. Overall, this sets the stage for the relationship of the vendor. You're letting them know that you're doing the right things, that you're going to be reviewing them on a regular basis, and they should be prepared to answer your questions and provide the evidence that you're requesting. Let's take a moment to outline some regulatory expectations. We know the financial services industry has really been the pioneer and primary drivers here. I'll point to the Office of Comptroller Currency, OCC, the FDIC. But beyond there, we see privacy. We see GDPR, CCPA. If you are a company with protected health information in the medical space, that's where we see HIPAA. So what I think everyone can benefit from regardless of the regulatory body that might be examining you, or if you're not regulated at all, is referring to this and understanding that there's a lot of best practices to understand and to know what does good look like. Well, it's right there in writing across the regulation and the supervisory statements that are outlined here. This is not a full list, but it's a good starting point. So needless to say, understanding your own regulation or your own regulatory body is first and foremost. But cross-referencing others, I think, is the key message. And there's a lot to learn as you compare and look at multiple bodies. Well, let's start to look at some fundamental concepts here. As we talked about, due diligence allows you to assess the vendor's controls. Typically, this is product and service related, not just the vendor organization. You have to drill down into what they're providing to you, what those risks are, and then the controls specifically around those product and service risks. Due diligence is based on complexity, so the higher the risk, the more rigorous due diligence, the more scrutiny you're actually going to be performing. Now, this can be accomplished through questionnaires. We work with shared assessments at VendMinder. We like the SIG questionnaires. In addition to questions, you should also be pursuing documentation or evidence to understand why the vendor has answered the questions the way they have. You can also conduct conversations with key stakeholders. For example, you might have your business continuity stakeholders discuss with their business continuity stakeholders the specific testing schedule, or disaster recovery, or cyber stakeholders. So those conversations are often really important above and beyond questionnaires and documentation. And lastly, you can consider on-site visits. This might be for more technology-based vendors, for example, if you want to tour their data center and understand the resiliency for very nuanced locations. So as a whole, due diligence can be accomplished a number of ways. Well, here we have a baseline document collection set that you're going to be looking at for all vendors, regardless of criticality, regardless of risk. Good starting point and foundation. You want to obtain these to do some checks. Consider initial vetting to make sure that they're a legitimate business in good standing with some good customer reviews, lack of negative news, and they're worth pursuing and performing a deeper dive of due diligence on. Looking at the list here, we can see some basic information, where they're operating from, maybe their URL, where's their headquarters, state of incorporation, are they licensed, are they approved to actually perform business. We've seen a lot of new, unique fintech and technology vendors come online. Well, it's very important for new organizations to prove this baseline of information exists and you're comfortable with the vetting that you've been pursuing here. You can look at Office of Foreign Agents, politically exposed people checks, whether there's specific certifications or licenses. We call out payment card or ISO certifications, credit reports, Dun & Bradstreet report if you have a relationship with DNB. Looking at vendor complaints, this is something that you could do on your own side proactively. You might look at referrals. You might look at negative news. List of subcontractors, certainly. This is something that you can request from the vendor, get an understanding of who they themselves are using for vendors. Look at a Google map. Look at their facility. Understand where they are. Are they geographically diversified, or are they all in one location, which increases risk, obviously, especially across the availability segment that we'll get to And again, just overall reputational checks, whether that's Better Business Bureau, CFPB Consumer Complaint Database is something that you could look across. So consider this at the vendor level before you get into the product and service specific level. Really strong set of baseline document collections or information to start to collect. So beyond the baseline set of information, here is additional documentation to collect. This is going to be for critical vendors. This is going to be vendors with elevated risks. And we'll talk more specifically based on risks, really detailed prescriptive evidence. But at a higher level, we talk about completion of a questionnaire for any information that's needed. Internal policies or governance materials. Have they put certain programs in place, like business continuity, for example? Audited financial statements, SOC, whether it's SOC 1 or SOC 2 or other independent third-party audit reports. There's always going to be a need for business continuities, disaster recovery, pandemic plans, regulatory findings or enforcement actions, litigations, judgments, and for organizations requiring it, environmental, social, and governance disclosures and reporting.
Here's our next poll question. How often do you perform due diligence on third parties? Only prior to the contract being signed, annually, periodically based on risk, periodically based on workload, we do not perform due diligence, or you're not sure? Greg, while we wait for these results, let's go ahead and answer another question from the audience. And that question is, should I request the same items for all vendors?
No. Really, the items you're requesting, the questions you're asking should be tailored by, one, product and service, and then two, risks. So for example, you wouldn't ask the same documents of your lawn technician as you would a core processor who may have access to customers' PII, nor would you ask the same of a company from whom you purchase software subscription to manage an internal process where it's touching no personal data as you would of your outsourced call center who is speaking directly to your customers daily, right? So your vendor should be risk rated to determine which documents, what questions are appropriate to evaluate controls.
Thanks, Greg. And just as a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This poll will close in just about 15 seconds, so please go ahead and get those answers in. Thank you. Okay, everyone, here are those results. Thank you for submitting your responses. Before we move on, I'd like to share that in the related content widget, you'll find our 10 tips for collecting vendor due diligence documents infographic. Document collection is often a challenge, but this infographic will provide helpful tips. Back to you, Greg.
Now we consider two primary ways of conducting vendor due diligence. They're both dependent on the upstream activity of the inherent risk assessment process taking place and understanding what the overall rating is, as well as the individual categories that have increased risk. I'll say categories or domains. So following that, first and foremost, you can perform due diligence based on the overall risk rating, whether that's high, moderate, low, for example. You're bucketing larger groupings together. A simpler way to carve up due diligence into 3 different variations. A little bit more tactical and specified and prescriptive is based on the inherent risks. What are the individual categories or domains that have been triggered? Those risk factors that apply specific to the engagement, to the product or service. So more cyber scrutiny as cyber's been triggered, more business continuity due diligence as availability and business continuity risks have increased. The next two slides will talk about common document collection items when you're pursuing risk-based due diligence. So for low-risk vendors, you're going to be considering and really focusing on that baseline set of document collection. As the risk increases, let's call it moderate risk, you're going to be adding to the baseline additional items for scrutiny. You might be looking at audited financials. If the baseline didn't provide you a credit report, this is where you can get into requesting specific financials from the vendor. Insurance certificates, especially if that wasn't part of your baseline effort. Any applicable compliance policies. Here's where you can get into the vendor's third-party risk management practices. So as you've learned that there are fourth parties here or vendors that your vendor is using, that's where you can start to now scrutinize their own program. How do they manage those vendors? And are they performing due diligence the way you're doing the best practices on your vendor? SOC reports, whether that is a SOC type, SOC 1 for financials or SOC 2 for privacy and resiliency, and the important areas in SOC 2. It might be a bridge letter that's depending on sort of the date stamp and when that's been provided. Reports, whether that's internal and external audits. You might look at anti-money laundering at this point for moderate risks. Info security, record retention, data destruction policies. Background checks, especially if this is not an automated product or service. We're looking at moderate risks. You know that there's a human resource element. So how is the vendor handling background checks? How are they handling hiring practices? And that's very applicable, you know, and widely as a blanket approach for moderate risk vendors. And now we get to high risk vendors. Of course, you're going to be considering all of the items previously stated in terms of baseline, low and moderate. But here we know that as a blanket approach for high risk, we want to take a deeper dive. We want to look at more policies and procedures. We want to look at biographies of key senior management and owners of the organization. What's that structure look like? Logical access management policy, data classification and handling policy, incident management policy, whether that's cyber or overall incident and crisis management. Look at business continuity and disaster recovery plans. What are they doing to test and to ensure availability and continuity of their operations, the data, and the products and services? We're going to be looking at penetration testing and vulnerability testing, network diagrams. What is the infrastructure there? How would they coordinate and implement or integrate into your own systems? You might be looking at data flow diagrams, and this also includes their own third parties or your fourth parties. You might be looking at records of outages and their historical violations of service level agreements. So this could be contractual obligations. This might be something that you look at for existing vendors, might be more challenging for newer vendors, but certainly keeping that in mind for high risk is to what extent are they able, based on history, to provide contractual obligations. And you also might consider an on-site visit. This might be more for technology-based high-risk vendors, but looking at their organization, directly and experiencing their physical security and their protocols inside of their operations is often a great step for due diligence for high-risk vendors. Well, as we move forward across the next few slides, we'll start to see due diligence based on actual inherent risk. So the areas in inherent risk that have been triggered and understanding what are the mitigating control areas that are associated with those categories and domains. And then, of course, what are the due diligence items that allow you as a potential customer to scrutinize those areas. So as discussed earlier, this is a little bit more of a granular tactical approach than due diligence based on overall inherent risk rating. This particular slide talks about higher risk critical vendors. So the control areas here would be availability, of course. Your criticality criteria, it will always be referencing impact to your organization if there's a disruption. So because of that, your concern in terms of mitigating controls would be availability, resiliency. So huge focus here on business continuity, disaster recovery, and then of course the staff that are operating the organization throughout. So you have reference to human resources, compliance, and even vendor risk management. And beyond the control areas for due diligence, then of course we see business continuity planning and testing, disaster recovery, the same, certification, across those areas, and then of course any policies, procedures across all of this. SOC 2 Type 2, if the individual business continuity planning and testing information hasn't been provided, you could be pursuing a list of their critical vendors, understanding who your fourth parties are, and proof that they do have vendor risk management or third-party risk management in place. Well, the next example that we have is a vendor that hosts or stores sensitive information. So the inherent risk there is going to be focused on control areas around info security, the human resource aspect of how their staff manage and are trained and compliant against best practices, privacy and compliance, vendor risk management, especially if you know that there's fourth parties that are potentially supporting the hosting or storing of this sensitive information. You also might include financial health. Generally, vendors that host or store sensitive information are not just high risk, but probably closer to critical vendors that are, really important to your organization. So knowing those control areas, you're going to take a deep dive into the due diligence items that are applicable there in terms of certifications, their regulatory compliance, policies, procedures, testing results. Again, we point to SOC 2, might be Type 2, which is a period of time, as opposed to Type 1 being a point in time. Vulnerability and penetration testing, not just the results, but what's the cycle? How often are they doing it? Are they running that internally, or have they hired an outside organization to do that penetration testing? So across the list of critical vendors, are they conducting due diligence? Do they have their own contractual clauses in place? So looking at the proof of vendor risk management, so important when you have fourth parties in play. Privacy policy, and then financials. Again, we talked about earlier, but scrutinizing those gives you a good understanding of how they're operating and if they're sustainable and viable. Well, this next example is heightened inherent risk because the vendor directly interacts with customers or clients. You might have had an inherent risk question that asked, does the vendor directly interact with customer or clients? Do they operate a call center? Are they performing a support function on maybe an outsourced technology? By identifying that risk, then you know that, okay, we're going to be looking at these control areas. What's their reputation around in the industry? And if your customers are aware that this is the vendor that you're operating with, to what extent are they well regarded? Human resources, how are they doing their hiring, their background investigations, their training for staff, their performance monitoring? You're doing performance monitoring on your vendor. What's your vendor doing in terms of performance monitoring on their staff that are directly interacting with your customers or clients? So control area around privacy, of course, control areas around compliance and risk management. Again, vendor risk management, it might be a fourth party that supports their product and service that happens to be interacting with your customers or clients. So in terms of due diligence items, think HR policy, again, evidence of background investigations and how they're training their staff appropriately. So those policies, procedures, any applicable certifications or proof of regulatory compliance there. Might be their privacy policy, which is where you see that they're testing frequently and training their staff how to conduct best practices there across privacy. Well, the next example for us is inherent risk based on unescorted physical access to facilities. Very unique one that poses certainly heightened risk. You could be thinking about janitorial staff, paper shredding companies, or contractors in general that every day are walking into your location, have access. So certainly you're going to be looking at human resources in particular, their background investigations, their overall training, performance monitoring, their compliance to their own HR processes. You're going to be thinking about who has access to your location. What are the evidence that they've gone through the right protocols in terms of privacy and compliance training, and your vendor's ability to manage and govern that to reduce the risk for these staff that are going to have access to your facility. And the last example we have for you is inherent risk that is related to significant cost. Based on experience, not all criticality assessments include a cost aspect, so higher costs sometimes are more on the risk side. In terms of mitigating controls, certainly there might be internal controls there that you want to make sure that the right approvals have taken place and the internal processes and mechanisms have been conducted correctly. On the vendor side, established service level agreements, making sure that you have the mechanism to monitor and you know that you're getting what you paid for. In terms of other controls, financial health, service availability. Oftentimes, significant cost is tied to products and services that are unique and maybe they're harder to replace. So those are the areas that are triggered and have higher risks specific to higher costs. And so, of course, you want to be looking at certifications and internal governance documents as it relates to availability, their customer processes and mechanisms in case there is an SLA challenge. Certainly SOC 2 Type 2, financials. So hopefully this gives you another good example.
The next poll question is, does your organization conduct due diligence on your vendors' third-party risk management, or directly on fourth parties? Yes, somewhat, no, or not sure. Greg, here's another question from the audience. How do I figure out who my fourth parties are?
Sure, great question. Well, first and foremost, one way is to simply ask your third-party vendors, even if it's a newer vendor, through conversations, through an RFP, right up through contracting. Simply ask who is material to the product service in question, who is in general critical to this vendor that you're speaking to. Now, in terms of due diligence documents, if the vendor has provided a SOC 2 report, typically fourth parties are listed there. And then another idea is contractually, you can obligate your vendors to make you aware when those fourth parties that are material to them might change in the future. Thanks, Jesse.
Thank you, Greg. If you have any issues submitting the poll, or if you have any questions, please reach out to us via the Ask Question widget, and we will be happy to assist. We do try to answer questions throughout the session, but if we do not answer your question live, we will follow up with you via email. We will be closing this poll in just about 20 seconds, so please go ahead and get your responses in. Thank you. And here are those results. Thanks again, everyone, for taking the time to answer the poll. Before we move on, please be aware that our due diligence checklist for low, moderate, and high-risk vendors is available for download in the related content widget. As we just discussed what documents to collect on your vendors, this is a very handy resource to refer back to. Greg, back to you.
Well, fourth-party risk is something that should be of concern for everyone. Everyone is using more and more vendors every year, including our vendors themselves, which means that you as a customer are going to have increased fourth parties year to year. So looking at your vendor's third-party risk or vendor risk management program is often going to be a really important step for you, especially for critical and high-risk vendors. You should be looking at collecting documentation to understand what they're doing to protect you from their fourth parties. Are they following the same life cycle that you're hearing through our bootcamp? You can be considering leveraging the SOC reports that often will list their fourth parties. You could also contractually obligate them to let you know when their third-party list has changed. And of course, you can monitor your fourth parties individually. Separate from performing due diligence on your vendors, you can bring those fourth parties into your own risk monitoring program, as long as you're aware of who those fourth parties are, which is so important for you to understand and have these conversations with the vendor about their program and who their fourth parties are themselves. So we should take a moment to talk about subject matter experts, or SMEs, and what their role is in due diligence. It is almost impossible to find one person with a skill set to conduct due diligence across all the different categories of risk. So cyber, business continuity, pandemic, and overall resiliency, info security, privacy, HR protocols, right? So it's really important you look at these individuals within your own organization and make sure they're prepared and trained as you're tasking them to review and assess the information that you're receiving back from the vendor. You don't want to be in a situation where the vendor gives you everything that you're asking for, only to find out that you don't have the right subject matter expert or they're not available. And we'll talk about cross-training and making sure that you have enough bench strength there, but we should define these subject matter experts now as a key role and a key piece to mechanize the due diligence process. They should have significant experience, knowledge across their area. In terms of governance of your third-party risk management, that's a key driver. You'll also see regulation around this is to ensure that you have subject matter experts that are trained and available to conduct this. Now, these fees can be internal or external, but definitely take a look at your overall approach for due diligence. What are the topics and categories, domains that are comprising your overall effort, and making sure that you have multiple stakeholders across those categories trained and ready to go. And that's your bench strength for your subject matter experts. Well, the last segment of our due diligence bootcamp, we want to talk about document collection challenges. You're going to be facing a variety of challenges. Not all vendors participate in the same way. We want to impress upon you these so you can be prepared and you can hear about some of our solutions that have worked well for us, some tips, best practices, and then of course we'll wrap it up with some key takeaways. So on the screen, of course, we're looking at the amount of time it takes to request questionnaires, set of evidence, to remind the vendor. Often it's unresponsive vendors that delay the process, and your business stakeholders are waiting, but this due diligence step has to take place. Maybe vendors won't provide documents or respond to a questionnaire, so it's a partial response. There's controls that are certainly going to be found that are not effective, that show weaknesses, and gives you a better understanding of whether or not you want to actually go into business with this vendor. Certainly we want to avoid only vendor level or organization level due diligence. You have to bring that product or service into the context of how we're performing due diligence. On your own side, lack of centralized repository. You might have multiple subject matter experts, as we talked about earlier. So having that process to easily find what they need to review and give you feedback is so important. Or there could be a lack of, what we'll say bench strength. So no available internal subject matter experts to review the complex vendor evidence. So imagine getting everything that you asked for and the vendors participating perfectly, only to find out that your subject matter experts are not available. They're on vacation, or they recently left the organization and you didn't realize. That's certainly a challenge. So having an understanding of who your subject matter experts are, making sure they're trained to your process and available is so key in terms of these challenges. Well, here's some due diligence tips and tricks. First and foremost, ask for everything up front. If you're doing things piecemeal, your results, your responses might come back in piecemeal. So definitely recommend to compile everything that you need for any particular vendor. Maybe it's across multiple products or services. So package that up and let them know everything that you need. Let them know what stakeholders they need to engage. It might be an account manager that's never done due diligence before. Let them know what you're asking for. What are the areas or the control domains or categories that are in scope here so that they can engage their own internal stakeholders to get you the right evidence or answer the right questions. Document your own attempts. Keep organized. Let them know that this is the third time that you've asked for a certain set of information. Keep that for reference in the future, especially if you move forward and contract with this vendor. You'd like to know that this particular vendor has been challenging historically. Set a schedule. Helps internally to let your vendor owners or the folks that are performing due diligence know when to follow up, or in the future, when to perform due diligence again. If it was a 2023 activity, do they have to do it in 2024? Is it high risk that they might do it on an annual basis? Or is it lower or moderate risk where it might be a different cadence than annually? So clarify and set a schedule and make sure that vendor owners are aware of it. Schedule site visits if needed. This takes coordination. Let your subject matter experts know that You're looking for, at a high level, a go or no go, but at a lower level, to what extent are these controls appropriate, or what you're looking for? So the quality aspect, as well as any nuances to contractual clauses, can be an output. So let your subject matter experts know you're not just looking for a yes or no, you're looking for some more input. What else can we do to insert internal controls on our side based on your own review of the due diligence information?
And now on to our last poll question of the day. How mature do you consider your vendor document collection process to be? Very mature, we have a list of prioritized documents to request. Mature, we're doing just fine, we typically get what we need. Immature, we've just gotten started and get inconsistent responses. We do not have a document collection process, or you're not sure. Greg, I have another question from the audience that we can go ahead and answer. And that question is, can one person review all documents?
Well, not typically, no. You have to remember that the higher the risk, the more areas that have been triggered, the more categories or domains. You'll find it challenging to find one person that can be a subject matter expert across all of these areas, especially when it comes to technology and cyber. There are some very nuanced artifacts that require experience that a technical person must review. So it's best to take an inventory of who can support document review and ensure they're available when these new vendors or existing vendors have made these documents available. Also, you want to remove single points of failure. So having a stable and multiple subject matter experts is best to avoid unavailability in those situations where the delays are on your side of the review and due diligence process. Thanks.
And here are those results. Thank you, everyone, for answering this question. By the way, within the related content widget, you will find our strategies to improve your vendor due diligence process infographic. Greg, I'll hand it back to you.
Well, here's some additional solutions and workarounds to consider as you run into some of the challenges. First of all, know what your preference is for documentation. Not all documents have the same weight. There are some that are mission critical to what you're doing for due diligence, and there are others that are nice to have. So determine if you can accept an alternative document. Request a vendor share a document online. Often they want to present it with an NDA or the promise that you're not taking screenshots. They just don't feel comfortable sharing the file. So it does take longer, and hopefully that's not something that you have to perform for every vendor. But having this solution as a workaround in your toolkit obviously is something to be aware of. Have a phone call to discuss the document. Perhaps you can ask the questions from subject matter expert to subject matter expert, and they can explain how they're doing certain things for controls. Request a redacted document. So that might not even come up. They might not have that prepared, but recognize that that's something that they could kind of compromise on. Obviously, you want to have a central repository for all your documents, right? These are controls that you can do on your side that really avoid challenges. If you have multiple subject matter experts looking for files, you want to avoid the delays on your side. So keeping that central repository, making sure everyone has access to it and it's maintained and everyone's trained on how to use that is definitely a solution to the challenges that we've seen. Ensure you're requesting due diligence at the product service level. It's not just the vendor themselves. It's not just that initial vetting on the organization. get specific into the product service and make sure that's influencing the context of how you're requesting information. And that often will give you the answers that you need in our workarounds or solutions to the challenges of not getting the right information up front. Again, the customer right to audit is a best practice that we preach that allows you to perform due diligence on a moving forward basis. It lets the vendor know that that's an expectation that they should understand depending on your cadence and your scheduling. Well, as we wrap up due diligence, I want to reiterate some key takeaways in that all vendors should be vetted to some extent, understanding at the vendor level, for example, where they're incorporated, where they're licensed, where they're operating from, versus at the product service level, those specific risks that are evaluated to ensure that the vendor is protecting your information and can actually execute on the contract, the contractual obligations. Due diligence should be in scope or proportionate to the risk. So higher risk means more robust, more thoughtful, more complex due diligence evaluation. Your subject matter experts should be reviewing the documentation. There's no one person that can likely review everything. So think about your cyber and InfoSec experts, your business continuity experts, your legal, HR experts. Get a team together. Make sure you have the right subject matter experts that can review the evidence that you're requesting. Be a little flexible. Certainly stick to your process, but think out of the box. If you can't obtain information from the vendor, challenge them to provide an alternative. Think about some solutions from the earlier slides. Work closely with the vendor. And if this is the only product and service for this unique product or service, rather, it might be the only avenue to have a little flexibility. So hopefully that's not the case for all of your products and services and experiences through due diligence, but occasionally you have to be a little bit more flexible, think out of the box, and you might have to jump on a phone call to have your team speak with theirs. And last, consider the strong contracting practices. Of course, we're recommending the customer right to audit and to make sure that you can perform this due diligence on a regular basis. But has your cyber or InfoSec subject matter experts found that they're testing for penetration enough? Maybe there's a clause that you want to add that they increase the testing in that area more frequently moving forward. So including contract clauses as a key output from your due diligence process is so important for your own internal controls.
Great. Thanks so much, Greg. Before we dive into more questions and answers, I would like to thank everyone for attending the first day of our 3-day boot camp. I would also like to thank our experts from today, Hillary and Greg, for their time in sharing some really important information on vendor risk and vendor due diligence. Tomorrow, VendMinder's president, Kelly Vick, will start us off by discussing vendor contracts. After Kelly's session, VendMinder's Information Security Operations Director, Lisa May Hill, will join us to discuss third-party risk management and supply chain, vendor data breaches, and complementary user entity controls within vendor SOC reports. Let's now go ahead and answer some more questions that have come in during this session. Okay, Hillary, this next question is for you.
Okay.
During due diligence, do you have to validate that the vendor has controls, or is your organization also supposed to test the controls?
So your organization is probably going to have a hard time testing controls unless they're directly interacting with your systems or whatnot. A lot of times with vendor due diligence, we'll be looking at a situation where they have something called a third-party independent audit, such as the SOC 2 Type 2, which not only establishes that the controls exist, but observes and tests them over time. So, generally speaking, your subject matter experts are going to look at the information provided and confirm that those controls exist, and depend on things like SOC 2 Type 2s to confirm that they've been tested. I hope that helps.
Great. Greg, we'll come over to you for this next question. And that question is, do I need to vet every single vendor?
No, not every vendor, but so this shouldn't be subjective. Formally, there may be exceptions to the scope of your third-party risk management program. So refer to your policy there or consider defining it if it's not there. Some examples are maybe one-time services or low-dollar vendors, maybe what you consider. We've seen government agencies, regulatory bodies, as well as financial market infrastructures, FMIs, in that exclusions list rather. So consider the governance materials, and of course, like any governance, make sure that all your requesters, vendor owners have visibility and are aware of that vetting scope. Thanks.
Thank you. Hillary, we'll come back to you for this one.
Mm-hmm.
What happens if your management accepts a vendor risk and there is some kind of problem with the vendor? Will you get in trouble with the regulator?
It all depends on the situation, but generally the point of a risk acceptance is to formally demonstrate and document that the right people were involved in the decision, that they thought through it, right? That it wasn't undertaken lightly. Now, just because they accept a risk is no guarantee that there's not going to be something that happens. And I think that most generally the regulators and auditors would accept that, provided you've done all your work. You've exhausted your due diligence. You've tried all the controls, and now we've decided to accept the risk. I think that's the important part. If you just said, hey, it's really high risk, we're just going to sign off on it without doing the work to get there, I think that's where the problem would be.
Great. And Hillary, we're going to stay with you on this one.
Okay.
Under what category do you discuss privacy risk?
Privacy risk generally falls under compliance, since most of the laws and regs around privacy are within the compliance kind of domain. But a lot of organizations also include privacy under their cybersecurity, so it goes hand in hand with sort of the data use and access. It's not that it has to be one place or the other, just as long as you have it covered. I think that's the most important part.
Perfect. Greg, we'll jump over to you for this next question. When should the vetting process start?
Technically, vetting starts right away. The internal business or the departments that identify the need for a specific product or service is vetting just by looking at all of the options in the industry, starting to consider reputation and public financial and other public information. But true interactive due diligence, as we talked about today, always follows risk assessment. So you can be very specific in the vendor control areas that you want to or need to vet and assess. Thanks.
Great. And Greg, this next question is for you as well. And that question is, how long should the due diligence process take?
Sure. Common question. This is really hard to quantify. It's based on several factors. So for one, the availability of your own internal resources, as we discussed, any external support in case you've outsourced due diligence, Of course, how quickly the vendor provides what is needed, how long it takes to review and make conclusions based on the information. So lots of variables. You could target 6 to 12 weeks as a baseline window. Really important to ensure that your business that's making the request and the business case, the eventual internal customers, are aware of the overall timing and the fact that certain steps have to take place. So knowing that, if there are bottlenecks or a queue, if possible, consider if your organization could prioritize certain requests. Put some in front of the others if and when needed. Thanks.
Thanks, Greg. I think we have time for one more question, and it'll come back to you as well. And that question is, does the board or senior leadership need to be involved in the onboarding process?
Onboarding, in general, yes. Good example there might be if a new critical vendor is being onboarded or going through planning, risk assessment, due diligence, and contracting, most of which was talked about today. They might be involved in those approvals for critical, but typically their involvement there is as an informed party. For example, they might want to see due diligence results, what's high risk, what's too much to accept and want to avoid altogether. They might want to see regular reporting, status of your own compliance to your third-party risk management policy. So where are you in the due diligence cycle? How many are complete at any one given time? Hope that's helpful.
Thanks, Greg. Unfortunately, that is all the time we have left for questions today. Thank you, Hillary and Greg, for taking the time to address some of those that came in. Any questions we did not have time to answer today, we will address offline. We'd like to thank you all for attending and hope you found today's session valuable. A big thank you to Hillary and Greg for their time and great content. You can ask even more questions inside of our third-party think tank and online community that is dedicated to third-party risk professionals and free to join. Just because today's session has ended doesn't mean the conversations and questions must. Post your questions at thirdpartythinktank.com and see what your peers have to say. In the community, you'll find thousands of free educational resources related to third-party risk management topics, such as vendor risk and vendor due diligence. If you'd like to become a member of Third Party Think Tank, you can register on the site or shoot us an email, and we'll get you registered and send you a link to set your password. We did record today's session, and that recording link will be provided to you in a follow-up email that you will receive Friday afternoon. Also in the email will be the survey link for you to request the CPE credits. We'd like to thank you all for attending and hope you found day one of the bootcamp valuable. I'd also like to thank Hillary and Greg again for their time. On behalf of InMinder, it has been a pleasure. Thank you, and we'll see you tomorrow for the second day of our bootcamp.